Eddie Ghabour is with us, owner of Key Advisors, taking a look into 2023. What are you thinking here as we're wrapping up 2022?
So going into next year, who knows what will happen here between the next 2 weeks, but I believe we are heading into the last leg of this bear market. And in my opinion, that's when it gets extremely tough, and it's the hardest part, because that's when your larger cap names start to really roll over, because the darlings of last year have already sold off significantly. So the last leg is usually the toughest for investors, but I think, unfortunately, the setup for next year in the first half is going to be extremely turbulent. And those that have cash going into next year will have some opportunities to make buys, but it's going to be a very tough market, especially for mega cap tech over the next few months.
As I was looking through Barron's, and I was looking for, they always do the top 10 picks for 2023, and they have a variety of names. I'll just fire them up, but you can see that they're in a bunch of different sectors: Alcoa, Google, Amazon, Bank of America, Berkshire Hathaway, also Delta and Comcast, and Madison Square Garden, Medtronic, and Toll Brothers. And they've done well with their picks. I mean, do you have any thoughts on any of these groups or names in particular?
So look, going into the first, especially the first quarter, right, when you have the cost of capital going up the way that it has and consumer demand coming way down, I wouldn't be buying real estate here. I would not be buying some of the tech names that are out there right here. Your consumer staples and healthcare, that's really the two sectors that we feel comfortable with owning. We own some healthcare. We own some consumer staples. We even own some utilities on the stock side. So those are three stock sectors that we have in our tactical strategy, but that's how defensive we are. Majority of our tactical strategy is in cash right now, because I don't think this market has really priced in a recession, and it surely hasn't priced in companies revising earnings substantially down. And I think that's what you're going to be faced with in January, maybe even starting this month. But the writing is on the wall, in my opinion. We're going into a recession, and we have to adjust to the new normal of higher interest rates for the foreseeable future. The Fed has spoiled us in the past with coming in to save the day. They're not going to do that this time. They've been crystal clear on that message to everyone.
Yeah, let's go back over some of those sectors you liked. You mentioned something defensive like consumer staples. Go through some of those sectors once more and explain, maybe even some names or types of ideas here for making some money in the new year.
Yeah, so I think, as I said, we just touched on those sectors, but I think another opportunity for investors is going to be in the fixed income market. We haven't seen rates like this in a long time, and that's a good thing for certain investors. I think there's going to be lots of opportunity in the corporate debt market next year. We plan to be buyers there. And we own treasuries right now, too. I know that may not be something that's real sexy to talk about, but at the end of the day, it's about trying to make money and reducing risk in this environment. And treasuries are paying investors a rate that they haven't seen in a while, because we do believe this economy slowing down is going to bring the long-term rates down on the bond side. So if you own longer-term bonds as a trade and those rates go down, those bond prices will go up. So we think there's money to be made there on the longer-term treasury side. The short-term treasuries are more of a hold because of what they're paying from an interest rate perspective. And then on dips, we would be buying healthcare, we would be buying consumer staples here on any type of dip. So the dip buying needs to be done in the defensive names first because of the setup going in the next year. And then I think when you go late into the first quarter, early second quarter, you can start looking at small cap sectors, maybe growth, probably small caps first because they don't have as much exposure to the dollar. So there's going to be a lot of tactical trades to make next year, as well as what I just shared with you that we currently own right now.
Yeah, and the other thing too is you're playing these defensive sectors. No mention of energy there. Are you done with the energy trade for now?
So energy has a tendency to actually go in the opposite direction when you're going into a recession, and that's why we don't have energy right now as a sector that we plan to buy right now. Longer term, there'll probably be some good dividend names to buy next year, but if we really are going to see a significant slowdown economically, which we do believe we will, the energy sector is not something that we want to be a part of because of how high the volatility is in energy. We're trying to keep volatility down going into the new year. Because again, I think the first quarter, if I had to make a bet, will be the toughest quarter of 2023.
Well, that's a good sign. I mean, that would mean that either we have a recession and get through it, or the takeaway from what the Fed is doing, you think a recession is likely, or I guess some tough times in this first quarter.
Yeah, and so look, the market's going to bottom well before the economy does. So that's what we want to be buying. You're not going to wait till the economy bottoms to start buying. But we just got to get this one last flush out to come through. And I think that's going to come a lot sooner than investors are probably anticipating.
Yeah. Eddie Ghabour, great to see you. Thank you, owner of Key Advisors. Thank you, Eddie.